Hello and welcome to my channel. This video is a part of NISM 5A Mutual Fund Distributors module. I've already made chapter 1 of this playlist. You can find and watch that video on the I button. You can also find the link in the description box and at the end of the video. For this one, we would be covering chapter number 2, that is concept and role of mutual fund. And do not forget to miss the 10 MCQs that is at the end of the video. It would give you an practical exposure after learning that can you attempt in the real scenario the questions that are related to this particular chapter. Alright, so let's start with the video and do not forget to hit the like button if you like the video and do not forget to subscribe to the channel for more upcoming videos related to this playlist. Okay, so starting with concept and role of mutual fund. What you need to remember is that mutual fund is a vehicle in the form of a trust. Alright, so notice this word trust. Whenever this question is repeated a lot of time, that how mutual fund is established in what form. Alright, so it is established in form of trust. It is not any bank, it is not any financial company. It is registered under Indian Trust Act 1882. As a trust. Now what happens that any trust works for the beneficiaries, for the benefit of someone. Now in case of mutual fund, the beneficiaries are the investors like me and you. So it works for the benefit of its investors. Alright. What is the main thing? That it invests in different markets and securities. We know that mutual fund is not a particular asset class. Mutual fund is just an investment vehicle which try to invest in different asset classes. So it could be equity, that is share, it could be debt, it could be bond, money market instruments, it could be gold, real estate, and number of asset classes, securities. But what mutual fund do is that investing in all these different securities here means different asset classes, different financial assets. Mutual fund invest in all those. Sorry for that interruption. And that is in line with stated investment objectives. So there are different objectives of the investors. Some like to go for higher risk, some like to go for lower risk and stable returns, while some investors prefer higher risk, higher return. So there are different investment objectives. It could be for retirement, it could be for children's education, it could also be for a long-term plan of 5 to 10 years financial growth. It could also be short-term like 30 days or 91 days. So there are different objectives which investors has, and what mutual fund do, it tries to invest in a portfolio of different securities to fulfill that objective of the investors. Now let's move to our second line. This is like through investment in a mutual fund, an investor can get access to equities, bonds, money market instrument. I already mentioned that what happens is mutual fund invest in different kind of securities. Now you as an investor, you are not ready to invest in stock market. You are not ready to invest in particular share because you are not having so much of idea related to it. So what you do, you go through the mutual funds. You go through a secure way. Now, you know that mutual funds are having fund managers that are professionals. They will be managing your fund. They will be investing in shares. They will be investing in bonds, debentures. They are well informed of all financial securities, and you will be presenting your investment objective and they will be investing on your behalf. So this is how mutual fund comes into picture, and it provides a way to the investors with minimum amount to invest in different securities and not to miss on any opportunity. Mutual fund offer different kind of schemes to cater to the need of diverse investors. So this chapter majorly focuses on different schemes of mutual fund. Of course, we are going through the concept and role of mutual fund right now, but we will see that there are different schemes, and because of so many schemes, oftentimes investors get confused like where they should invest. So it becomes important that you are having an idea, an overview that which scheme would be suitable for which investor. The money that is raised from investors ultimately benefit government, companies and other entities. Okay, what you need to notice over here is that where does the money go? So we as an investor, we are investing in mutual fund, right? Fund managers are investing those money of ours in different portfolio which consist of shares, which consist of bond, debentures, depends on the fund objective. Now that money is raised by the governments, the companies that are issuing the bonds and debentures, the companies that are issuing their shares. So those companies, those governments, they are trying to raise the fund from the public to invest in their projects, to expand for the expansion of their business and various other expenses what they need to cater. And what happens in turn, that when the business goes for profitability and the demand for their shares, their bonds, their debentures are high in the market, the prices go up. And ultimately, we as an investors, we are benefited with the rise in the price of that particular share, that particular bond, or that particular unit of mutual fund. So this is how the whole system works. Okay, now let's see investment objective. Now, investment objective of various schemes stems from the basic need of an investor, like safety, liquidity, and returns. So as an investor, when you go to invest in one particular mutual fund, what you look for? You look for the risk. All right, so that becomes the first question of any investor, that is it very riskier? What is the risk associated? Will I lose all my money if there would be any problematic situation in the market? Because often that line comes now, that mutual fund are subject to market risk. So that is like, it creates a little bit of fear in the investors. So you are always looking for safety. All right, so how much risk is involved? And these all things, it has been made mandatory by the SEBI that whenever you are choosing a scheme, you can see on the website of the mutual fund that is being provided by the companies. So you can see that there they mention the riskometer. So whether the risk involved in one particular scheme is low, it is high, it is moderately high, or very high, that would be shown through riskometer, which is very easy to understand for the investors. Other than that, there are information given related to return percentage, the past performance. So that has been made mandatory so that the investors are well aware where they are investing, and it doesn't happen that they are having any kind of fear or doubt related to one particular scheme. So what investors are looking for? They are looking for safety. They are looking for liquidity. All right, so mutual fund, most of the schemes that are provided by the mutual funds are open-ended. Now, open-ended funds are providing a kind of liquidity also, because you can easily enter and exit from that particular mutual fund scheme. Now, entry and exit means that you can easily invest your money and redeem your money. Redeem means selling the units and redeeming your money back into your account. So you can easily purchase and redeem as per your wish. You do not need to hold for a certain period of time. That happens in close-ended scheme. But for most of the mutual fund schemes presented that are open-ended, you are free to make an entry, to make an exit. So that is liquidity. You are having a kind of liquidity in this particular mutual fund. Then you can also go through returns. Returns are always mentioned over there for 1 year, 3 year, 5 years. The past return for 1 month performance, you can also see 3 months performance. So that is mentioned on the website on that particular scheme which you are investing. All the information is given. All right, so you can go through it. And this is what is the primary objective of any investor: the safety, the liquidity, the return. They are looking for return that should be higher returns, right? So here you can also see this table. It is extracted from the PDF of your this NISM mutual fund distributors syllabus. So here you can see, like depending on the type of mutual fund scheme, you can match with the investment objective. So if you are investing in overnight fund, what is your investment objective? You intend to provide reasonable income, that is with high liquidity. High liquidity because you are investing only for one business day, and within 1 day your scheme will mature and you will be able to redeem your money. In the same way, when we come to equity fund, we are looking as an investor for capital appreciation. Now that could be for a longer period of time, but what we want is higher return. What we want is appreciation in our capital that we have invested. Then there comes hybrid fund, which invest in equity as well as debt. So it try to maintain a balance between some kind of security also for your capital and a little bit of risk so that you can generate higher returns. So there comes the hybrid fund. Then there is fixed income fund, which tries to provide you a steady source of income through by investing in fixed income securities. So different types of mutual fund schemes have different investment objectives. So whenever you are choosing one mutual fund scheme, you need to see that whether your investment objective matches with that particular scheme or not. Okay, so let's move to investment policy and important concepts related to mutual fund. Alright, so when we talk about schemes investment policy, it would be to disclose two aspects, that is asset allocation and investment style. Alright, so you need to remember this line, that schemes investment policy would disclose two aspects, asset allocation and investment style. Alright, so investment style here, it could be active, it could be passive. Active means the fund managers will be having more power to change the investment portfolio, like which shares should be included, which companies should be included, which companies should not be included, in order to outperform the market returns. So they could decide on the asset allocation, they could decide on the investment style, and that is what is mentioned in the investment policy of any particular scheme. Now coming to important concepts. So first is units. The investment that an investor makes in a scheme is translated into a certain number of units in the scheme. Okay, so what happens is that for 1 unit of one particular mutual fund scheme, there is a price set, what we call NAV of that particular mutual fund scheme. So let's take it with an example. So for example, SBI Blue Chip Fund, the NAV right now would be somewhere approx for direct plan, it would be rupees 50. So what happens that if you are investing rupees 500 for 1 month, you would be getting 10 units of that particular scheme. Okay, so unit is one quantity. Unit is representing one single quantity of that particular scheme. So it depends how much money you have invested. According to that, you would be provided certain number of units of that particular mutual fund scheme. So it's like you are buying those units of that particular scheme by paying a price that is in form of NAV, that is net asset value. Net asset value in simpler terms is price of mutual fund. So here 1 unit means one single quantity of one particular scheme. Face value. Typically every unit has a face value of rupees 10. Now face value you can understand as the original cost price of 1 unit of scheme. Alright, so what happened that initially when a fund is presented, it is at its face value. Alright, so this is the cost price. You can in simpler terms you can take it as cost price, which is typically kept as rupees 10 in terms of mutual fund scheme. Now unit capital. So we know what is unit. Unit is one quantity. Face value is cost price of 1 unit of any particular scheme, that is generally rupees 10 only. So unit capital is number of units issued by a scheme multiplied by its face value. So when we multiply units into face value, we arrive at unit capital, and that is the capital of any particular scheme. Now coming to recurring expenses. Now recurring expenses are the fees or commissions paid to various mutual fund constituents. Okay, so let me make it simpler. So there are expenses involved like management fees. So fund managers, they charge their fees, right? So there are expenses related to distributors' commissions. So banks, they act as distributors of mutual fund. So SBI, SDFC, all they, when they are presenting the mutual funds, they are acting as distributors. So they charge their own commissions. So there is distributors' commission involved. There is marketing expenses involved, trustees' fees, etc. So all these are recurring expenses, which is totally translated into expense ratio. Now that expense ratio would vary between 0.5% to 2.5%. It depends on what kind of scheme you are choosing and what is the related expense ratio of that particular scheme. So expense ratio is recurring expenses, those are collectively translated into expense ratio, and this expense ratio you can find that easily whenever you are going to choose a scheme. There would be mentioned the expense ratio of that particular scheme, so you can see, and as I mentioned, it varies between 0.5 to 2.5%. Now NAV I already told, it is net asset value. In simpler terms, understand as price of mutual fund. So when you are buying 1 unit of mutual fund, you are paying the price to buy that particular unit, and that price in terms of mutual fund is called net asset value, that is NAV. Alright, so you just go through it and you'll get an idea. And here it says that when you liquidate your money, when you sell your holdings or your units, this is NAV what is converted into cash. So what price would be going on at that time, that is converted into cash, and that's how you try to make the profit. Like you invested when the NAV was low, and when the NAV went high, you sell your mutual fund scheme, and that is how you generated the profit. So NAV is what you get after liquidating your mutual fund. NAV keeps on changing because it depends on the market price, the market fluctuation. So NAV is changed every day, and you can just see that. AUM is asset under management. The sum of all investment made by investors in mutual fund scheme is the entire mutual fund size. All right. So asset under management is like in one particular mutual fund scheme. So there are many investors who have invested in one scheme of any mutual fund. So the total investment size, the total investment collectively made, that is considered as asset under management. So if a scheme has a positive profitability, this asset under management goes up because more and more people are investing in one particular scheme. That would lead to profitability, and that would lead to higher AUM, higher asset under management, because there is more money. And what happens vice versa, that if there is negative profitability, the AUM will go down. Now let's come to mark to market. So mark to market is the process by which NAV is calculated. I said that NAV is calculated on daily basis, and this is the process that is used. So this process is used for valuing each security. Now when we are investing in one particular mutual fund scheme, that scheme has a particular investment portfolio. That investment portfolio will consist of different companies. So different companies, their different shares. Now when we there is a process called mark to market. This process, it tries to value each security in the investment portfolio. And after accumulating all the securities value, we try to arrive at NAV, that is net asset value. So mark to market is the process of calculating value of each security included in investment portfolio of the scheme, which is this process is generally applied or generally done to arrive at net asset value of one particular mutual fund scheme. Alright, so I hope this is clear that one mutual fund scheme, it has its own investment portfolio which invests in different companies. So you can go through that also. As I mentioned, that it becomes very important that when you are investing in mutual fund, you check on the past performance of the mutual fund, you check the NAV, you check the risk involved, the return and the expected return, what we say, and the investment portfolio. Because looking at the investment portfolio, you'll get an idea, okay, so this particular scheme is investing in very good companies, it's very reliable companies, trustworthy companies, so you would be a little secure that where your money is going. Now let's come to advantages of mutual funds. So first is professional management. We already talked about it, that there are fund managers who manage your money. So you get a professional management for your invested money. Then you go through portfolio diversification. All right, so there are different kind of mutual funds. There are multi-cap also. Multi-cap fund, what it does, it invests your money in different, like in large cap companies, in small cap, in mid cap. So in a way, it tries to diversify your fund. So this is also one of the benefit of mutual fund, that it provides you portfolio diversification, and that too in a very small amount. So can you expect that you are investing only 500 and yet you are provided units of, and yet you are able to invest in so many companies which is there in the portfolio? Like if you go by yourself to invest in a stock market, you will require certain good amount of money to diversify your investment well. But through mutual fund, even through 500, even through 1000, you are getting your whole portfolio diversification. So this is again one of the advantage of mutual fund. Economies of scale, of course, again this is linked to the second one. As I mentioned, that with the minimum investment amount, you are able to get higher benefits because collectively your money is used along with other investors, and then it is invested in different companies. So you get you get the benefit of diversification as well as economies of scale. Transparency is now there in mutual funds, so it's not riskier as it is presented, because you are getting to know the NAV. You are able to track the NAV of the mutual fund, that is price, and then you can see all the details, as I said, the risk involved, the return, the past performance. Along with that, you are provided monthly statements of where you have invested, so you get that monthly statements onto your registered email. So it has become very transparent, and thus it is again an advantage of mutual fund. Liquidity is there, I already talked about it. Tax saving, so there are also funds which provide tax saving options to you. Along with that, mutual fund has its own benefit that the tax is not deducted. When you are investing in share market and all, there is capital gain tax, long-term capital gain, short-term capital gain tax. However, in terms of mutual fund, there is no such tax levied, and thus there is a kind of tax deferral. And there are also tax saving funds like ELSS, equity linked savings scheme. So you also get through certain tax saving funds which you can claim in your tax deductions. It is also a convenient option, of course. So investment comfort you get, regulatory comfort, you don't have to worry about it, because as other capital market instruments, mutual funds are also regulated by SEBI. SEBI, that is Securities and Exchange Board of India. So SEBI regulates mutual fund, and hence you have that regulatory comfort in terms of this as well. Systematic approach you get, and that's the main advantage nowadays of mutual fund. Whether we talk about SIP, that is systematic investment plan, SWP, systematic withdrawal plan, STP, that is systematic transfer plan, you get a systematic approach to mutual funds. So by monthly you can invest your amount, monthly you can withdraw by investing lump sum. So you get that systematic approach, which is again one of the advantage of mutual fund. Now let's come to limitations. So along with advantages, there are also few disadvantages you should be aware of. So there is lack of portfolio customization. Now this means that you cannot customize, right? You are investing in one particular mutual fund scheme, you have chose that scheme, and okay, you have invested your money, but you can't decide that your money would be invested in which companies, which shares of the companies, which bond, which debenture. You can't decide that. That is decided totally by the fund manager. So it's like you cannot customize your portfolio yourself. You can choose the scheme as per your objective, but you cannot choose where to invest the money involved in that scheme. So there is lack of portfolio customization. Choice overload. With so many mutual fund schemes, oftentimes investors are not able to choose the right one. So there is a lot of choices which generally becomes a burden for the investors. They are not able to make a decision. No control over cost. So this is related to the expense ratio, what we see. So there is a kind of cost involved which goes on higher side if you are not making a wise decision. I have also made a video where I said that what you should do, you should choose for the direct fund rather than regular fund. You should go for lower expense ratio. This is how some of the means you can apply to reduce your cost and get the maximum benefit out of mutual fund. No guaranteed returns. So it is generally it is written, it's like this is related to market. So obviously when the market will be performing well, when your mutual fund scheme, the investment portfolio, the companies involved in that investment portfolio will be performing well, your scheme will be performing well, then you can get a good return, you can expect a good return. But when the scheme in which you have invested has not performed well, obviously there is risk that you won't be getting good returns, and so there is no guaranteed returns. As in stock market, that the same concept in mutual fund also, because it's indirect way to invest in those securities. So it's linked to market. If the market will be performing well, if the company where your money is invested is performing well, if it is highly valued in the market, then you will be getting good returns. But in case the scenario is totally opposite, Obviously you have to take the risk, you have to hold your invested money and wait for the right time to sell the scheme and generate the profit. Now let's come to classification of mutual funds. So basically it is classified, we can classify it on the basis of 4 types. So on the basis of management style, we can classify mutual fund as active fund and passive fund. On the basis of structure of fund, open-ended, close-ended, interval fund. On the basis of scheme, equity scheme, debt scheme, hybrid scheme, solution-oriented scheme. On the basis of investment universe, we can classify as equity fund, fixed income fund, money market fund, gold fund, international fund. So this is totally how it has been given in your PDF. In the same way, I am covering it so that it becomes easy for your exam and you don't get that confusion or complex in understanding. So okay, so when we are classifying as management style, you can classify as active fund and passive fund. Now, active fund, what happens that the fund manager is having the flexibility to choose the investment portfolio. They can construct the investment portfolio. They can decide which companies to keep in the portfolio so that they can outperform the market. So there is higher involvement of fund managers in the active fund. And this is why the expense ratio would also be on higher side. However, in passive fund, the expense ratio will be on lower side because the fund managers won't be so involved in making the decisions. Now, passive funds generally seek to track the index. So they don't, the fund managers don't really go for which companies to choose, how the portfolio should be constructed. They just track a particular index like Sensex, and then the same companies that would be involved in the Sensex, they would be choosing the same companies. There would be same allocation of invested money. So it's like passive fund. Here the expense ratio would be low. Active fund expense ratio would be high. Passive fund expense ratio would be low. Active fund managers would be more performing. Passive fund managers would be passively looking at the fund, so they won't be much involved. Now coming to structure of the fund. So open-ended fund. Open-ended fund are basically what most of the schemes that are provided are open-ended only, and we would be looking in the further slides. So open-ended, you can make an entry and exit from the fund as per your wish. So you can invest your money and redeem your money whenever you want. So that is open-ended fund. Close-ended fund, you have fixed maturity period. So you have invested your money during NFO, that is the new fund offer. When NFO was going on, you invested your money. Later on, you have to hold that money for till the maturity period. Once the maturity period is completed, your money would be returned in your account with whatever profit or return percent that would be involved. So it is like close-ended. Once you have purchased, you have to hold till the maturity. Then comes the interval fund. Interval fund is a kind of close-ended fund, but what happens that for a pre-specified interval of 15 days, it generally becomes open-ended. So for 15 days, it would become open-ended and you can buy and sell the units from that. And later on, again, it would continue to become the close-ended fund and you have to wait for the maturity of that particular fund. So this contains the characteristic of both open-ended and close-ended. Okay. So over just a glimpse of whatever I said. Open-ended, here you can make entry, exit, you can buy, sell as per your wish. Close-ended, you have to hold till the maturity period. Interval fund, it is a combination of open and close-ended. Now on the scheme basis, there is equity scheme. Equity scheme generally invests most of your money in the equity instruments, alright, so the shares of the companies. Debt schemes invest major proportion in the debt instruments. Hybrid scheme is a combination of equity and debt. And then there are solution oriented, which focuses on retirement, children's education. So those would be solution oriented. Again, equity fund we talked about. Fixed income fund would try to provide you with a stream of fixed income. Equity fund would try to provide you capital appreciation in longer period of time. Money market fund would be more liquidity, would have more liquidity because it would be short-term fund. Gold fund would be investing in gold, and thus that would be the major portfolio, major investment amount would go into the gold instruments, then international fund is there. So these are the basically classification of mutual fund which we can see. Now let's come to equity schemes. Okay, so starting with multi-cap fund. Now multi-cap fund would have large cap, small cap, mid cap. Okay, so first you need to look over here. It is mentioned over here. What is large cap companies? This is 1 to 100 company in terms of full market capitalization. Alright. So market capitalization means whatever shares of the company is there in the market and the share price when we multiply that. So share price into number of shares in the market, that becomes market capitalization. Now top 100 companies in terms of market capitalization are referred as large cap. Then 101 to 250 are referred as mid cap, and then small cap are after 251. So this is how we can classify large cap companies, mid cap companies and small cap companies. Now when we talk about multi-cap fund, what happens is that it diversify your investment in all these three types of companies: large cap, mid cap and small cap. More than 65% of your investment will be in equity instruments only. So if you have invested around 100 rupees, more than 65 rupees would go in equity instrument. Equity, I already mentioned, it is share of companies. You can, so it is riskier one. Then there is large cap fund. So large cap fund, with the name you can just get an idea that more than 80% would be invested in large cap companies. Large cap companies we just saw over here. So these would be the most growing companies, most reliable and stable companies. So more than 80%. So if you have invested 100 rupees, more than 80 rupees would be invested in this type of company. Mid cap fund, it would be investing more than 65% in mid cap companies. So if you have invested 100 rupees, more than 65 would be invested in companies falling in 101 to 250 in terms of market capitalization. Then there is small cap fund. So small cap fund is the more riskier one, because these are the these companies has a lot to reach now. These are at the initial phase, and thus small cap companies are riskier one, because as I said, large cap companies are the more stable and grow and has already given a good growth. So large cap companies are stable one, they are having a good market capitalization. Small cap companies are riskier one. So in the same way, small cap fund, because it invests most of your more than 65% of your amount in small cap companies, it is riskier one. So since these all are equity schemes, these are all riskier because they are investing in shares of the companies. But when you get the question that which would be more risky, you have to choose small cap fund, then it would be mid cap, then large cap and then multi cap, because it would be totally diversified. Now one thing more, that these are all open-ended schemes. Alright, so these are open-ended schemes. I already told what is open-ended, what is closed-ended. So all these are open-ended schemes. Dividend yield fund, these invest in dividend yielding stocks. So most companies, what they do, good growing companies, they provide dividend to their investors. Now dividend yield fund, they try to focus on those companies which provide dividend to the investors. So they majorly invest in dividend yielding stock. Then there is value or contra fund, which follows a value investment strategy. They look out for those companies which can provide high growth in the coming future and which is not valued much in the market right now. So they go for a particular investment strategy. Focused fund, here your money will be invested in maximum 30 stocks. So it would be diversified in maximum 30 stocks, and those 30 stocks would be in focus to provide the investment objective of yours. So this is referred as focused fund. Then there is sectoral or thematic fund. Now this is also very risky, sectoral fund, as compared to small cap fund. Also, if we have to choose that which one is more riskier, small cap fund or sectoral fund, we have to choose sectoral fund because these are more riskier. Now this is riskier because they invest more than 80% of your money in one particular sector. So for example, they are investing, if you have invested 100 rupees, more than 80 rupees would be invested in banking sector. So if the banking sector would not be performing well, your money would be at risk. So there would be one particular sector in which these fund would be investing. It could be banking fund investing in banking sector. It could be infrastructure fund investing in infrastructure sector. So they focus on one particular sector. ELSS fund, this is a tax saving scheme. It comes with lock-in period of 3 years. So it is equity linked saving scheme. Okay, so these are all the equity schemes. These are all open-ended schemes. As I already told, the most riskier one is sectoral or thematic fund because it concentrates on one particular sector. If that sector does not perform well, you lose your money. If that sector performs well, you gain good percentage. So it is riskier one. Along with that, small cap fund is riskier because these are those companies which are at the initial phase and thus they are going through a lot of fluctuations, a lot of market fluctuations. Then among these, what is more safer as compared, it could be multi-cap fund, it could be large cap fund, and then ELSS fund. So this is how you can categorize the equity schemes. Coming to debt schemes, first one is overnight fund. So overnight fund invest in securities with maturity of 1 day. We already saw that in previous slide also. Then there is liquid fund. Now your investment in securities with maturity up to 91 days. Okay, one thing more I want to mention that you will often get questions, and that's why I have mentioned these days so clearly that you keep this in mind. You keep notice of for how many days, what is the maturity period, and in the previous equity schemes you keep a note of all the allocation which I gave, like 80%, 65%, 30 stocks. So you need to keep the numbers in your mind. Then there is short, medium, long duration fund. Okay, debt schemes as compared to equity schemes are safer one. Equity schemes are more riskier. Debt schemes invest in debt instruments which are safe as compared to equity. So you can consider it. Then there is short, medium, long duration fund. Short duration fund would be between 1 to 3 years. Medium duration fund would be for 3 to 7 years, and long duration would be more than 7 years. Then there is money market fund, which invest in money market securities like treasury bills, the commercial papers, the certificate of deposits, which are having maturity of short period, that is generally less than 1 year. So these are money market fund. Then there is dynamic bond. These are open-ended scheme, again dynamic debt scheme investing across durations. Corporate bond fund, so there are corporates which issue their bond in the same way like government issues their bonds. So there are corporates also issuing their bond, and when the fund invests in those corporate bond, this is corporate bond fund. So minimum 80% of your investment will be going in AA plus rating corporate bond. So if you have invested 100 rupees more than minimum, so minimum 80 rupees will be invested in AA rating corporate bond. Then there is credit risk fund. So minimum 65% of investment in AA rating corporate bond. Now this is a higher rating provided. AA plus is a more higher rating, so you can consider it as more safer. But here it is a little riskier because it is AA rating. So it is lesser than that rating, and thus it is referred as credit risk fund. And here approx like 65% of your money will be invested in those corporate bonds. Then comes banking and PSU fund. So here 80% of your investment will be in debt instruments of bank and PSU. PSU means public sector units. Gilt fund invest minimum 80% of your investment in government securities. Then there is floater fund, which invests 65% of your money in floating rate instruments. Now here all that I have mentioned, these are also open-ended scheme. Previously, all that I mentioned in equity schemes, those were also open-ended schemes. So these are provided to the investors. Whenever they want, they can make an entry and exit from the particular scheme. Debt schemes are safer as compared to equity schemes. And here if we talk about which one is more riskier, I would say it is credit risk fund. I already mentioned also. Other than that, corporate bond fund is also riskier because So you need to look for the rating. Here the rating is good, but in case that when you go for government bond fund, it's more safer as compared to corporate bond fund. So your gilt fund is safer because it is investing in government securities. And then banking and PSU fund, again it is concentrated to debt instruments of public sector units and bank. And here you can see the maturity days. You need to keep that in mind. Now let's come to hybrid schemes. So it would be a combination of equity and debt schemes. So first one is conservative hybrid fund. Now investment in debt instruments shall be 75 and 90% of total asset, while investment in equity and equity instruments will be 10% and 25%. So in simpler way, if you are investing 100 rupees, your 75 rupees, 75 to 90 rupees will go in debt instrument, and your 10 to 25 rupees will go in equity instruments. So it is kind of providing you a conservative balance, where most of your money is going in safer instrument, that is debt instrument, and lesser money is going in equity, that is a riskier one, so that you can generate good return in lower amount. Then there is balanced hybrid fund. Investment in equity and equity related instruments shall be 40 to 60%, and then again in debt instrument it would be 40 to 60%. So it is kind of providing a balanced option in equity and debt. You are getting an exposure of both type of fund, both equity, both debt. So you can generate high returns also by taking higher risk. You can also be at the safer side. So if you are investing 100 rupees, 40 to 60 would be invested in equity, 40 to 60 would be invested in debt. Now then there is aggressive hybrid fund, which invest your major proportion in equity, that is 65 to 80%, and lesser proportion in debt. So it is just opposite of conservative one. Conservative is providing higher exposure to debt instrument, which is more safer. Aggressive is providing higher exposure to equity instrument, which is little riskier. So if you have invested 100 rupees, 65 to 80 will be invested in equity instruments, 20 to 35 will go to debt instruments. Alright, so this one is aggressive hybrid fund. Then there is multi-asset allocation, which invest in at least 3 asset classes. So asset classes could be different. Asset classes like equity, debt, gold, these are 3 asset classes. So it can invest in at least 3 asset classes with a minimum allocation of 10% in each. Then there is arbitrage fund, which try to invest in arbitrage opportunities with minimum investment of your 65% in equity and equity related instruments. So you just keep this mind, all these are open-ended scheme, these are hybrid schemes. The more riskier one is this one, aggressive hybrid fund, and then this arbitrage fund. The safer one is conservative hybrid fund, and alright, so balanced hybrid fund. Okay, so if we need to categorize, we can categorize as equity schemes are the riskier one, then comes the hybrid scheme, and then the most safest is debt schemes. Now some more funds which you should be aware of. So there are solution oriented schemes, for example retirement fund, which focuses on providing you a retirement solution. So it is having a lock-in period of 5 years or till the retirement age, whichever would be earlier. The main focus would be to provide you with good capital appreciation so that you can use during your retirement. Then there is children's fund. Again, this comes with a lock-in period for at least 5 years so that your money can be utilized. It can mature to provide you good benefits till your child attains the age of majority. Then there are other schemes like index fund. Index fund generally try to replicate or track index. So there would be total, whatever would be the companies there mentioned in the index. For example, Sensex fund. So Sensex fund will be tracking Sensex. The Sensex belongs to Bombay Stock Exchange. So Sensex will be having 30 companies, and what would happen that the index fund would have same 30 companies in the same allocation, asset allocation, like how much money should be invested in each company. So there would be same asset allocation and same companies would be involved. It would try to replicate or track the index. So 95% of your total investment amount will go in the same securities. Then there is fund of fund. Now what happens, this is a type of mutual fund that invest in other mutual fund. Okay, so one fund investing in other mutual fund is what we call fund of fund. Okay, so some more funds, then there is fixed maturity plans, and I know it's hectic, like there are so many schemes, but what you need to have a glimpse of each scheme so that when you get the objective question, you can easily get clicked in your mind and you can choose the right option. So this is generally asked like this: is it open-ended? Is it close-ended? What return per, no, what allocation percent, like 65, 80%, which one is riskier, which one is safer? So this is how you get the question. Fixed maturity plans are kind of close-ended debt fund. Okay, so finally we are to the close-ended scheme. You need to keep this in mind. Fixed maturity plans are close-ended scheme. So you have to hold your money invested in that till the maturity of the scheme. Capital Protection Fund, again, this is also a close-ended scheme which which is hybrid fund, and it try to when you try to invest in that, you have to hold for a particular maturity period. You try to hold that. The exposure to equity is typically taken through equity derivatives market, and principal amount is invested in debt instruments. So you can see that there is a balance of there is investment in both equity as well as debt instrument, where major amount is going in debt and lesser amount is getting the exposure to equity. Infrastructure debt funds, so these are again close-ended mutual funds which are investing minimum 90% of the money in the debt securities of infrastructure companies. It could be related to infrastructure projects, infrastructure SPVs, that is special purpose vehicles. So anyhow, directly or indirectly, they try to invest in infrastructure related funds, related debt funds, and that would be minimum 90%. Again, you need to keep in mind that these are all close-ended schemes. Real estate mutual funds, 75% or more of the net asset of schemes shall be invested directly or indirectly in real estate asset. So you can get this idea from the name also, that it is investing the major proportion, that is 75% or more, in the real estate assets. Okay, so now comes our MCQ time. Oh, alright, so you need to go through all the 10 questions. First question is, mutual fund is a vehicle in the form of a blank to mobilize money from investors to invest in various markets and securities in line with stated investment objective. Option A, trust. Option B, bank. Option C, custodian. Option D, advisory firm. So the right answer is option A, trust. Second, mark-to-market MTM considers which of the following value for valuing each security in the investment portfolio of the scheme. Option A, book value. Option B, current market value. Option C, net asset value. Option D, face value. Correct option is option B, current market value. Blank indicates how much money can be generated per unit of mutual fund in case the scheme is liquidated. Option A, asset under management. Option B, net asset value. Option C, market price. Option D, exit load. So the correct option is option B, net asset value. Which of the following is an advantage of mutual funds? Option A, customized portfolio. Option B, convenience to buy stocks and bonds from mutual fund. Option C, economies of scale. Option D, investment advice. So the correct option is option C, economies of scale. The funds that combine feature of both open-ended and close-ended schemes are called option A, interval funds. Option B, dual funds. Option C, middle funds. Option D, intermediary funds. So the correct option is option A, interval funds. Which one of the following is not a systematic approach to investment? Option A, systematic investment plan. Option B, systematic withdrawal plan. Option C, systematic transfer plan. Option D, systematic pension plan. So the correct option is option D, systematic pension plan. The unit capital of mutual fund scheme is derived by multiplying number of units issued by its option A, face value. Option B, book value. Option C, market value. Option D, net asset value. So the correct option is option A, face value. Funds that invest heavily in equities, usually exceeding -% of their portfolio, is called an equity fund. Option A 55%, option B 60%, option C 65%, option D 50%. So the correct option is option C 65%. Which of the following is not a sector fund? Option A power fund, option B infrastructure fund, option C banking fund, option D diversified fund. So the correct option is option D diversified fund. Which of the fund are generally more volatile in nature? Option A gilt fund, option B exchange traded fund, option C diversified equity fund, option D small cap fund. So the correct option is option D small cap fund. Okay, so thank you for watching. I hope you like it. Do not forget to hit the like button and do not forget to subscribe to the channel and watch the first part of this video and keep a track to see more videos related to NISM mutual fund. Thank you all.